Good afternoon, traders. It's Bill Baruch with Blue Line Futures, and this is what's moving. We saw a wave of weakness to finish out the day. The S&P did go red. The NASDAQ gave a bulk of its gains up, but did still finish positive. We saw the S&P sort of stall through much of the day, exhausted against this 2887 area. We've talked about that battleground level. Sellers came in ahead of there. The NASDAQ, it did really decisively get its head out above 9,000, but did not settle above there. Again, another divergence here with the rest of the market and the tech behemoths. Take a look quickly. We'll start off with the heat map. Microsoft, Apple, Facebook, Amazon, all green. Even like the Netflix, some of these semiconductors, all performing much better than the rest of the market. Red across the board, all the financials. Healthcare did not participate. Healthcare helped keep the S&P in check with the NASDAQ yesterday. But again, industrials, everything across the board, just very poor performance outside of tech. And again, you can see it here in the charts. But first, the S&P, this line right here is that 2880, 2885 area. It's a big battleground. We've talked about it many times. We got our head above there twice and for two sessions, but really the second one finished poorly. We're now below there fairly decisively, and staying below there what we should believe is opens the door down to 2732, which what we sort of thought that wave to start this week could do. Didn't quite get there. Overall, we've also talked about below this area, the path of least resistance is down here. This is our rare major 4-star support. It's not just this line. There's a number of technical indicators that come into about 2640 that we're eyeing to the downside that this market really should. But that's why you have to manage risk properly. These markets can remain irrational longer than you can remain solvent. It sounds cliche, but it is true. Now take a look at the NASDAQ here. NASDAQ, just such a tremendous run, outpacing the S&P. This 9,000 area really got its head above there today. You can kind of see here, it's been a couple times it's head above there. But again, another tail. This again, we should see some follow through the downside here. But is it the NASDAQ that can really do it? Or is it the S&P that's really the one that's going to achieve it? And then if we do get that weakness, you want to see this NASDAQ here, 8630. There's a lot of support levels. We detail those in the Morning Express. You want to keep an eye on those. Where can the NASDAQ turn around and really start to lift the rest of the market? So keep an eye on that. We have a big finish to the week, obviously. Factory orders from Germany this morning, they were pitiful. We had other Eurozone numbers. Retail sales was poor. Coming into the U.S., ADP payrolls were higher than expected. Crude oil did trade lower after EIA today, but the EIA really wasn't a bearish report given the relative to expectations. We saw about 200,000 barrels per day come off production estimated. We saw less builds than expected. And crude oil, a big draw in gasoline. So we actually saw a knee-jerk higher across energies after that number. Then they came in pretty heavily. Some technical exhaustion we talked about in the Morning Express today did come through, but then they finished the last back half of the session on an uptick. Let's take a look here on crude oil. You can see this is where this stalled out resistance. Number of levels here, but the 618 retracement is the easy one to see. You do have where this big selling picked up and it broke down. This was coming out of a weekend, that Monday session, and then the July followed through pretty sharply. This is July. So this is an area here, not surprising to see this thing kind of run out of steam. Our downside we talked about, 2340, previous highs, number of technical indicators aligned there. That's what we're looking for. If you were fading this move, a minimum, you want to be able to capitalize down there. Now, can we get there? We believe so. It's going to be an interesting back half of the week. I think I got distracted in talking about the data today, but tomorrow we still got more data. We still have industrial production from Germany. You have the Bank of England tomorrow. They're not expected to do anything with rates. And then weekly jobless claims here in the U.S., it's going to be a big number, 3 million they're expecting again. But then it leads into Friday. Nonfarm payroll is going to be the big one. I think it's about a 16% unemployment rate they're expecting. And then you got Chinese trade balance Thursday night too. So we get a number of things to look for here as the week winds out. Volatility is going to stay out there. We just took a look at the crude oil chart. We're talking about currencies. Let's see here. I mean, we talked about the euro earlier in the week. we've been dollar bullish, and this is a longer term play for us. It's not just a short term trade. And we talked about this euro hitting up some resistance the earlier part of the week and coming off. And it's actually done exactly what we were pointing to. Coming down here to a target range, about 107.60, let's call it 107.80. And we tested into that today, finding some support. Now, if we get euro bearish news and we get dollar bullish news throughout the rest of the week, we believe we break through that. This is going to be a defining moment potentially. Obviously, non-farm payroll, no one really knows the type of emphasis that we're going to see on non-farm payroll this week relative to the strong emphasis we've had, the markets have had on non-farm payroll, the markets reacting to non-farm payroll in the past. Obviously, weekly jobless claims is a very much more up-to-date. We got a watered-down version with ADP today. So the expectations are fairly out there, but it's the headlines. The headlines may drive the markets, and we could get additional volatility. We expect some additional volatility just because how big of the number is. But the currencies should move. So if we see dollar bullish data, we're going to see the dollar make a move. It's going to pressure that euro lower. And then here, look at this chart. These are some of the areas that you got to have on your radar if we start breaking down. I mean, these are all previous lows. Previous lows going back to 2016, 17, in the euro, 106. You got 105, let's call it, and then down here, 103.70 area. We start getting through here, break down, and again, there's still a lot of work to be done breaking down through here, but we break down through there. There's no reason to think that we can't start testing in some of these supports and make a new low in the euro. And that's one of the reasons why we are dollar bullish. Another one that we've been looking, we like fading. We think that this thing is definitely exhausted, and it came back to the scene of the crime, March 10th, where this thing really started to fall out. We got above a good trend line, and we talked about it the other week, talked about this resistance area, got above there. Now it's got to break back down through here. If it's a slow mover, that support's going to continue to drop down. But ultimately, too, this is the area you want to see this at minimum. 61, 60 or so. It's going to be a big support in the Aussie. We think it can get there. Our belief is that the Aussie can get there. A number of reasons, but obviously an exhausted market. We think risk sentiment, risk assets following that should come in a little bit. We can't emphasize enough that how the U.S. and China trade war is not in the news as much. Yeah, you hear Trump talk about it. You see headlines. But the markets are very, very, very quiet reacting to this. They're not taking this in, and they're not taking it seriously. If we see a new chapter in the U.S.-China trade war, that's going to pressure risk assets, and you're not seeing markets price that in yet. And Trump is saying in the coming weeks, we are going to be able to see if China has followed through with their commitment of purchases. So it's going to be pretty pivotal. Again, a lot of data to finish out the week, a lot of jawboning coming from the White House, and then we're going to next week, we could see more in the U.S.-China trade war. And if we finish this week like that, there's going to be some fear we could start to see more of it over the weekend. We do not think this market, whether it be the Aussie or stocks, we're not seeing the market price this in just yet. So let's go ahead and take a look at the yields, because this is another narrative this week that we've seen. The 10-year yield stretched higher today, out above 70 basis points. Now, on Monday, Mnuchin talked about a record supply of treasuries hitting the market, record borrowing from the Treasury. What they're going to do is they're going to print more. They're going to do that through Treasury auctions, and what that means is supply. That's the prices that we trade in these markets. And we'll get to the bond quickly here in a second, but prices are what we trade, and more supply is going to pressure those prices down. So yeah, there's ultimately buyers of that to keep rates suppressed, but that supply is coming down the market, and you can see that being the elephant in the room this week in the bond market, because so yields, you got a little bit more room of the upside here potentially in the 10-year, but the bond market has been hit pretty hard. And this may not look like a big move, but this has been a 4-point move here on the week in 3 sessions. A 4-point move in the bonds, it could sometimes take a month to see 4-point move in the market in the bonds before all this volatility hit. So The bonds did finish, the 30-year bond did finish off its low fairly well. 50-day moving average here, a good floor down there. There's a lot of support in the bonds here. We like the bonds long term. We do think there's going to be one more move higher, but obviously they have not reacted so much to some weakness in the equity market that's fairly quiet, but they're more so reacting to the additional supply coming on the market here through August. So that's scaring the market a little bit. Can we find some support down there? And one thing it's really weighing on, this move in treasuries is really, really weighing on gold. Gold has a number of narratives, and some days it feels like every negative narrative is just acting together. But really, it's been the bonds here quite a bit. It's been a stronger dollar today. You see gold down 1.5% today, coming back in to, again, retest this area, this breakout area. We need to respond against this. There's a little bit of a trend line here, bringing in support in that, about 179, 180, or sorry, 1679, 1680. We'll see some support there. Rising 50-day moving average. Hopefully that can start to get closer to this previous low, 1660, 1666. So there's a lot of support down here, and gold. The thing about gold is the commitment is very bullish right now. There's a lot of bulls out there, but we have not seen the follow through. So it seems to be setting up for a little bit of a shakeout with some pressure on the treasuries, stronger dollar, a little bit of a shakeout. But that shakeout that comes in gold is exactly the reason why you almost want it. You can see the buyers come in and buy that up, shake out the weak longs, then this thing could rip 50, 60 bucks. That's what's going to be important. But you can see here at the metals complex, the deflation, is also just kind of working through on gold too. This is palladium. Palladium, the high flyer, 2,800 bucks in February before this thing just completely fell out of bed and literally lost 50% in a matter of 2 weeks. It had that oversold dead cat bounce. And now it's just trickling lower. There is no doubt that palladium is weighing on the metals complex here, and 4 tough days in a row is ultimately keeping people from, when gold was moving well, from potentially pushing through some resistance at 1730 and through 1740, which became resistance in 1725. So this is really weighing on on gold too. And we'll leave you with this. This is one that you got to watch. There's a lot of lines drawn on here. It doesn't look pretty, but I just want to emphasize the number of support levels that converge here for silver. Silver has lagged gold. And again, things like palladium could be really weighing on silver more. Weakness in crude oil weighing on silver more than gold. But silver needs to respond. So whatever you want to call it, down here to 1450 is the 382, to these trend lines all converging here. It's 1475, 1470. Silver needs to get out above the 50-day moving average. And we say this all the time. If you've followed our stuff for a while, I always say the 50-day moving average in silver is critical. If it gets above it, it trades above it for a long time. If it stays below it, it stays below it for a long time. We need to see silver close above the 50-day moving average. And for now, that 50-day moving average is coming in pretty sharply. 1520. There was a point that it was all the way up at 16 bucks. So now silver really has its work cut out. It needed to close above the 50-day. It needs to get above here, and it really needs to get above 16 bucks. So it's silver. Silver has its work cut out for it, but that's what gold needs in order to finally turn around. All right, so you got a big week to go. A lot coming out over the next 24, 48, and hours here to finish out the week. And remember, non-farm payroll Friday. A number of data pieces tomorrow. Bank of England. Give us a call. We're always here to help. 312-278-0500. But remember, futures trading involves substantial risk of loss. It is not suitable for all investors.